Shares of UiPath, as I said before the break, are trading now. It's one of the biggest software IPOs ever. Our Leslie Picker following the money on this IPO, as she does for all of them. So how are we supposed to think about this one?
Yeah, so I would say this one is a perfect reflection of what's been going on with its peers in the publicly traded marketplace. You look at a lot of the recent activity among software stocks recently, and we have a great chart that can show you some of the bigger names off of their recent highs. You can see a major revision in how investors are valuing software right now. UiPath, their decision to go public right now is a perfect reflection of that. So you can see Snowflake off 46%, Zoom Video off 45%, Qualtrics 39%. And so the way that these IPOs are valued is they basically take companies that are similar, whether it's business model or customer base or so forth, and they pull together all of those inputs. They say, this is how we should value a company, a new issue like UiPath in the public markets. Well, when you have those peers, those comparables in the publicly traded markets that are down significantly like they are here, you have to take a step down in the valuation for these IPOs, maybe more than they would have wanted. For example, UiPath right here is at 65.48. That is just about in line with where they raised money back in February at a $35 billion valuation. Their IPO pricing, however, during their roadshow, they were actually looking to price significantly below that round and then raise the price range and then priced above that price range, but still below their latest round from February, which is just the perfect microcosm of what we're seeing in the software industry as a whole right now in the publicly traded markets.
There is a lot of talk, too, about the private down round, right? When sort of looking at that company and then gauging what the IPO was going to look like. Do you know off the top of your head, and forgive me for just throwing this at you if you don't, like what kind of price to sales we're talking about with a company like this? Only because it was such in focus with a Snowflake, for example, which was, you know, in the stratosphere.
In the 70s, yeah. Yeah, when Snowflake went public, I think it was about 70 times. This one's about 52 times annual revenue at the IPO price. So trading a bit above that right now, maybe about 53 times. So significantly higher than most software stocks that you think of. Still below that of software, but higher than almost all cloud stocks that we've been tracking. So it's certainly not cheap on a price to sales metric by any means. But, you know, from a psychological standpoint, if you're an investor and you say, OK, well, it's still coming below its latest private round, so, you know, maybe we are getting a bit of a deal here. Another important kind of technical factor for this one, they're only floating about 4.5% of the stock. Oftentimes when you see that, you do get quite a bit of pop because of the various supply and demand dynamic. Now, this is a $1 billion plus IPO, so there is that. But, you know, 17%, we're not used to seeing 17% pops for software IPOs within the last year or so, especially some of the bigger ones that were heavily anticipated, such as this one. Now, I think people who look at the IPO process would say 17% pop is perfect because that means they didn't leave as much money on the table. But just kind of noteworthy for, you know, especially as we look at what's gone on with IPOs in the software space over the last few years or so.
Yeah, you can't win either way.
You can't.
Right? All right, Leslie, I appreciate it. Thank you.